It's an urgent warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the Biden administration is about to do the unthinkable, and I want you to understand why this is so bad, because anytime we head into a recession or all-out financial crisis, we can look back to the tipping point where it all started. And what I want you to understand is what the Biden administration is about to do could be that tipping point that kicks off an all-out global trade war that plunges the global economy into a deep recession. Plus, we have a sponsor of today's show. We'd like to welcome Cybeats Technologies. They're a global leader in cybersecurity technology, and they have some really cool technology, nothing like I've ever seen before. You can find them on the CSE under symbol CYBT and on the OTCQB under symbol CYBCF. And if you're a long-term investor, I think this is an impressive opportunity because they are a potential buyout candidate. And if you're a trader, we talk about on the Sunday show, buying at the bottom of these supply zones. I'm going to show you why the last time it touched this level, it went on to rally 75% and how it could do that again. Stay tuned to the end of the show or check out the pinned comment or description for more information, because this is one you don't want to miss out on. Now let's head over to Bloomberg, where he picked today's story up with a headline: as the U.S. floats tougher trade curbs and chip crackdown on China. And this had an immediate reaction to the market that sent the NASDAQ plunging as investors started to realize that this could trigger an all-out global trade war and have a massive impact on the U.S. chip makers because their stocks are at really high valuations. And one of the challenges here is we see investors crammed in the same stocks, and anything that could change the momentum of the market could have massive effects on the U.S. economy, as you're about to see. And seeking leverage with allies, the U.S. is mulling whether to impose a measure called the Foreign Direct Purchase Rule, or FDPR. The rule lets the country impose controls on foreign-made products that use even the tiniest amount of American technology. And you can imagine that there is a bit of U.S. technology in foreign chips all over the country, and now the Biden administration is looking to crack down on that in a major way. And such a step, seen by allies as draconian, would be used to clamp down on business in China by Japan's Tokyo Electron and the Netherlands' ASML, which make chip-making machinery that's vital to the industry. The U.S. presenting the idea to officials in Tokyo and The Hague as an increasingly likely outcome if the countries don't tighten their own China measures, according to people, of course, who don't want to be identified. But talking about something we should identify, and that's opportunities in the market. Let's take a look at this chart for Cybeats Technologies. Again, on the CSE under symbol CYBT, on the OTCQB under symbol CYBCF. And you look at these two supply zones, and how do we know what these are? Well, we can see that stocks trade between zones with the buyers below, the sellers above. The last time it touched down into the zone, it went off to rally 75%. It's down here again, and you can see, of course, the one-year volume supply level is sitting up here right above 20 cents a share. That's where the sellers are at, creating a tremendous opportunity for you. Stay tuned at the end of the show for more information, as the administration is now in a tenuous position. U.S. companies feel that restrictions on exports to China have unfairly punished them and are pushing for changes. Allies, meanwhile, see little reason to alter their policies when the U.S. presidential election is just a few months away. And that's what makes this move somewhat surprising to me, because, of course, we know that presidents love to brag about the U.S. equity market and how well it's doing. And this would be a big plus for President Biden as he seeks re-election to say, look, under my term, stocks went to new all-time highs. But now he's threatening to break the markets as investors look to flee at a point where everybody is crammed in these stocks that could lead to a massive amount of selling and a big correction in the U.S. equity markets heading into the election, making this what I believe is a very dangerous move for the administration. The goal is to persuade allies who have already restricted some shipments of key equipment to limit their company's ability to service and repair restricted gear that's already in China, which the U.S. firms are barred from doing. The U.S. is also weighing additional sanctions on specific Chinese chip companies, which could then threaten a trade war at the most inopportune time, again, for the administration and the U.S. economy that's looking to kind of regain its footing and attempt the impossible of a soft landing. But if we have a trade war and countries start fighting about this, then what it means is there's no chance that we could achieve what the Fed says they believe we can do. Of course, you know that I don't think that's going to happen, but I want to know, weigh in the comments, what do you think? Is this a smart move by the Biden administration, or is this the wrong move at the wrong time? The prospect of stricter trade rules would suggest that attempts to form a unified front against China's chip ambitions have fallen short. The U.S. imposed sweeping restrictions on the sale of advanced chips and manufacturing gear to China back in October of 2022 and tightened those measures 1 year later as part of a campaign to prevent Beijing from gaining cutting-edge technology that could boost its military. And so you can see the motive here for the Biden administration. But one of the problems is we look at China. Their economy is falling into recession and likely to experience an all-out financial crisis because we know their property developers are insolvent, which means their banks are insolvent as well. And this could be the one thing that pushes them over the edge and they look to retaliate. And if that should happen and things start to get worse, well, it means their economy is going to plunge and they're going to drag us right down with them. And this is not good sign for U.S. consumers if there's a trade war, because that could lead to higher prices at a time that they cannot afford them. But the policies have also cost American companies billions of dollars in revenue, and that's the risk here and why we're seeing the reaction from the market. And as we look towards this earnings season for this quarter, we're now going to hear companies start to talk about what's coming, and if this happens, it's going to be disastrous for their revenue and their earnings, which could cause their stock prices to plunge at a time when investors believe that the U.S. equity market is indeed the safety trade. The U.S. chip industry argues that it has shouldered an unfairly large part of the burden and that there needs to be more allied cooperation to prevent China from finding ways around the existing controls. Of course, we know China will do everything they can, and this is the reaction today as stocks get hit amid sell-off and global chip makers. And if this continues to accelerate to the downside, the risk is we'll see a lot of quant programs, we'll see a lot of machine traded programs, we'll see algorithmic programs all look to sell as the market goes down, and that could accelerate to the downside because this is typically one of the weakest times for the market, particularly as many people are on vacation. This could lead to a massive correction and cause panic for investors and even further cut spending as people, of course, react to a loss of wealth. And from the U.S. to Europe and Asia, chip makers came under heavy pressure today as American powerhouses NVIDIA, Advanced Micro Devices, and Broadcom drove a closely watched industry gains down by 4%. Meanwhile, across the Atlantic, ASML Holdings plunged 10% even after the Dutch giant reported strong orders in the second quarter. Those moves followed a plunge in Tokyo Electron, which led a slide in Japan's Nikkei 225 stock average. And as you can see, it's not about current earnings, it's about the next quarter and the one after that. And of course, if the Biden administration does this for the chip makers, it's going to be disastrous. The summer correction is close at hand, with U.S. stocks expected to fall in weak seasonality and stretched positioning. This according to Goldman Sachs Global Markets Division Managing Director and Tactical Specialist Scott Rubner, who we often feature on our Sunday show. Today, he notes that historically marks the peak for the S&P 500 returns in data going back all the way to 1928, to be followed by the worst month for equity outflows in August. The pain trade is no longer higher from here, he says. I'm not buying the dip at all, suggesting that if there is a catalyst to drive stocks lower, that it could accelerate again as everyone's crammed in and looks to get out and machines start to turn and burn and cash in on their gains. We could see a massive correction this summer. And again, for the Biden administration, who needs every bit to support the case for re-election, a large correction in the equity market wouldn't do it. But perhaps the U.S. economy economy is going to experience a soft landing. Well, at least that of the U.S. industrial output, as it posted the largest back-to-back gains since 2021. Here we see factory production notches a broad advance led by consumer goods. The question is this data lagging, or does it suggest that we are indeed achieving a soft landing? We're going to put that to the test as a 0.6% increase in production at factories, mines, and utilities, followed by a whopping revised 0.9% gain a month earlier, marking the biggest 2 months advance since 2021. And here you can see the biggest back-to-back gains are now potentially indicating the U.S. economy is about to experience the mythical soft landing. Even factory output rose 0.4% in a broad advance that included gains in autos, electrical equipment, appliances, and non-durable goods, following May's upwardly revised 1% increase. Mining and energy extraction rose 0.3%, while output growth at utilities accelerated. And at the headline, this looks fantastic. The data is really suggesting that the Federal Reserve really nailed the job here, and all they need to do is pull back on the restraints with a couple rate cuts here, maybe one later this year and into early next year, to let the economy really run. But there is something that suggests that perhaps the headline government data might have it wrong. Manufacturing, which accounts for 3/4 of total industrial production, has had difficulty building momentum amid rising input prices, and higher borrowing costs have restrained investment. The Institute for Supply Management's widely followed measure of factory activity has been stuck in contraction territory for all but 1 month since October 2022, suggesting that there's some reason there's a deviation between the U.S. government data and what the surveys are showing. And sure enough, we can see a relationship as we look at survey data here, this from the Philly Fed's current general activity index for the manufacturing sector that's shown in red. And you'll notice rather noisy, this against industrial production in blue, which is shown on a year-on-year rate of change. And you'll note that the survey data usually, which is very volatile, leads, of course, the actual data. But in this case, are we seeing the rollover in the survey data as the ISM suggests and some of the other regional Fed surveys suggest, and that we're actually experiencing a lag in the actual headline government data? That's entirely possible here, but there are a few cases where the government data leads the surveys. Of course, we'll be watching this closely because it has serious implications for the U.S. labor market and inflation as well. The Fed's report showed capacity utilization of factories, a measure of potential output being used, rose to 77.9%, the highest level since September of 2023. The overall industrial utilization rate even rose to 78.8%. And we note that output of consumer goods rose 1% in nearly most of the year. And how about motor vehicle assemblies? They surged to 13.4 million on an annualized basis, the highest in nearly 9 years. So is this a case where demand is driving output, or perhaps the factories are just continuing to turn out goods in hopes that people buy them? Well, there is some inflationary risk here. As we look at the capacity utilization index in blue against the consumer price index in red, that's shown on a year-over-year rate of change. And you'll note that where capacity utilization goes, it tends to have an inflationary effect with a lag, suggesting that increases in capacity utilization have everything to do with increase in demand from consumers. This case here, are we seeing a legitimate turn in the U.S. economy as capacity utilization turns higher, or are we going to see this turn and move to the downside if inflation continues to fall? We still don't have the answer to what's going on here. This could be just a lagged effect of the government data. But there's one thing we can watch on a weekly basis, and that is the labor market, because it has a strong relationship with the factory sector. And here you can see industrial production in blue still on a year-over-year rate of change against continued unemployment claims. Now, we see a further increase in unemployment claims and people staying on unemployment, then it will tell us something's very seriously wrong with the economy. Now, every Thursday, we do get the new data on initial and continued claims, but let's take a look at the relationship here with the factory sector, because what you can note is that as industrial production turns up, as shown in blue, what happens to continued claims claims as they go down as the manufacturing sector looks to hire more people and bring back some of those who are on the unemployment line. So we see that relationship happen over and over, suggesting that if this rise in industrial production isn't a lag of the survey data, that perhaps we should see a corresponding drop in continued unemployment claims. If we see a further rise in continued claims, then what it does suggest is the high possibility that the government is just lagging the surveys. But can we look to other markets such as crude oil to give us some indication? And absolutely we can, as oil recoups losses, as technicals add to support, because if indeed factory production is headed higher, well, that means demand for energy is going to be there as well. Let's take a look at the Department of Energy. What do we see? A big drop in crude oil, 4.87 million barrels, suggesting that there is demand for crude. But look at this. Here we are in the summer season. This is something that was very concerned about. Gasoline inventories up 3.3 million barrels. Distillates, think about jet fuel. This is where that goes, 3.45 million barrels. So we're seeing a draw in crude inventories, but product inventories are rising, suggesting demand from U.S. consumers here is in decline. So maybe this is factories building things in hope that people will buy it. Well, we'll find out soon enough. But let's take a look at the relationship between crude oil prices, here shown on a year-over-year rate of change, also against industrial production, that in blue, also again on a year-on-year rate of change. And you'll notice there is a very good relationship between the two, suggesting that perhaps the recent increase in crude oil is actually transmitting into the factory sector as demand rises. But of course, we can't look past the discrepancy of the survey data from the regional Fed and the ISM and S&P Global. Of course, we'll look for further information, but our key focus will be to watch the labor market. And if we see oil prices turn lower, well, that will be the red flag that this is just lagging data and that the U.S. economy is about to make another major leg lower. Of course, it won't help. Of course, these chip companies are likely to see their stock prices fall if the Biden administration pushes forward here. But will the Fed look to react? Well, not in time. As we note, they never do. Here we see that Waller says the Fed is getting closer to cutting rates, but, well, not there just yet. As he said, current data is consistent with achieving a soft landing. It gives us kind of the picture of that unless the labor market unwinds here. And I'll be looking for data over the next couple of months to buttress this view. And, of course, he's from the Kansas City Fed, and while he doesn't believe we have reached our final destination on inflation, that is, and we have not, I do believe we're getting closer to the time when a cut in the policy rate is warranted. And that is what the Fed said. They were going to over-tighten with the idea to pull back a little bit. And so we do expect at some point there'll be a cut. The issue is, though, when the Fed cuts, it usually means things go wrong. And there isn't one cut or two. It's usually a series of cuts all the way. We'll be back to zero. And Waller said the labor market is in a sweet spot. Well, that's just for the moment, where job growth is not excessive and wage increases, in his view, are nearly consistent with stable prices. The problem is we've seen a continued deceleration in wage growth against what's still sticky inflation, meaning that consumers do not have the ability to keep up with higher prices, which means they cut spending, and that will impact the labor market and perhaps make sense why we're seeing gasoline and distillate inventory builds. He noted that layoff rates have been steady around 1%, and the unemployment rate, while higher, remains historically low, which is true, but for now. And to me, this is all evidence of labor supply and demand imbalance, but that can change in a major way. Even so, the Fed governor added there is more upside risk to unemployment than we've seen in a long time, and they'll be paying close attention to the employment side of the central bank's mandate, because again, we'll be paying close attention to that weekly data. If that continues to tick higher, watch out, because by September, well, because even Williams agrees we're actually going to learn a lot between July and September, which suggests, of course, if the labor market unwinds here, that we're going to see the Fed begin what will be a series of cuts as the U.S. economy and the global economy head into recession. But one company we think will be immune to that as demand for their technology is surging, and that is our sponsor of the show, Cybeats Technologies. You can find them on the CSE under symbol CYBT and on the OTCQB under symbol CYBCF. Let's take a look at what's going on with Cybeats. because they help clients identify and manage cyber vulnerabilities within their software components, a crucial cybersecurity measure. By streamlining the handling of cybersecurity vulnerabilities from open source software components, which constitute over 80% of software, into a single technology interface, Cybeats uses automation and prioritization to enable clients to move away from the outdated practice of managing 50 to 100 spreadsheets per day. This approach not only enhances efficiency, but also significantly reduces costs and optimizes cybersecurity risk management, and something we think that this company is likely to be, and that is a buyout candidate. If you look at their current NAV price, it's a huge opportunity if you're a long-term investor. If you're a trader, we're going to show you a setup, a move between supply zones that could realize a 75% return in your pocket. Let's take a deeper look at what's going on with Cybeats, as the product is fully built and operational, having validated its market approach with 100% client retention, servicing mainly US and European blue chip clients such as Schneider Electric. They've achieved a significant year-over-year revenue increase of 693%. They're currently on a 320% annual growth rate, achieved with just a sales team, if you can believe this, of one person. And right now, Cybeats is planning to aggressively grow the sales force to drive revenue expansion. And their contract is with one of the largest U.S. defense agencies, and 80% plus of their clients are Fortune 500, with 89% of clients who's trial the products turn around and end up buying it. And this is setting up an attractive stock price entry given historical equity financing, which were completed at 50 cents and $1 per share. And there's right to participate in the industry consolidation, something we believe could lead, of course, to a buyout opportunity. And the market for SBOM is exploding here in the US and the EU as federal regulations across industries are forcing new software compliance. For example, the FDA required medical device manufacturers to provide SBOM for software on their medical devices. And then recently, they announced a press release that they offer comprehensive intelligence for AI software products. Its customers can now manage risk, ensure the integrity of their AI systems, and detect weaknesses and vulnerabilities within software components. Cybeats has closed more client contracts in Q1 2024 than they did in the entirety of 2023. And here you can see that press release as they unveiled artificial intelligence capabilities, delivering enhanced insight for clients' AI software. And the integration of AI bomb aligns with the European Union's AI regulation efforts, as well as the Department of Homeland Security, as they provided new AI guidelines in their safety and security guidelines for critical infrastructure owners and operators, which include sections on software for security and safety. These new guidelines and imperatives cover vendor-provided hardware, software, and infrastructure, develop and host an AI system, and when possible, should incorporate vendor risk assessments and documents such as software bill of materials, AI system bill of materials, data cards, and model cards. The aggregate regulatory landscape marks a positive market tailwind for Cybeats and its new AI capabilities, as the global AI government's market size was valued at $124 billion in 2022 and is expected to grow at a compound annual growth rate of 36%. Now let's take a look at that chart we looked at earlier in the show, and you can see these ranges here. These are supply zones. These are where the buyers are at down here. This is a unique opportunity to be buying at a prior level of support. And the last time the stock traded here, it rallied up into the zone where the sellers were, which you can see is marked here right by that volume profile line in red, and it broke just briefly above that and generated a 75% return for those who are buying at the bottom end of that supply zone. And as we zoom in here, you can see just how it trades rapidly between those zones, suggesting that anything that could set the stock off, any catalyst, could send it rapidly rising there, giving you an opportunity to get in now with the current NAV price at the time of filming between 12 and 13 cents, making this an easy opportunity for everyone to participate in. And here you can see as we zoom into the 30-day chart and we look at the volume profile line at 15 cents, you can see buyers underneath here. A break of that 15-cent level would be the catalyst to send it all the way up into that upper supply zone, giving you the potential to realize a a 75% gain. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.